These are real tax returns from last year, same income bracket, same filing status, but one person paid $33,899 less in taxes. That's enough to buy a new car every single year, in cash. The difference? Right here. This single paragraph, Section 179, lets businesses deduct not just a portion, but the entire cost of equipment purchases up to $1.2 million in the very same year they buy it. Not depreciated over 5 years, not spread out, written off immediately. And before you think this is some shady loophole, the IRS designed this to encourage businesses to invest in growth. But here's the shocking truth. According to IRS data, only 58% of eligible businesses even claim this deduction. And of those who do, 65% don't maximize their benefits. That's billions in legal tax savings left on the table every year. Today, we're breaking down exactly how to use this powerful tax strategy, whether you're a full-time business owner or building a side hustle while working a job. Section 1. The $1.2 million rule and who can use it. Let's read the law verbatim from irs.gov. To qualify for Section 179, 3 boxes must be checked. 1. Qualified property. The IRS defines this as tangible, depreciable business equipment used more than 50% for income-producing activities. That includes things like Ford F-250s, computers, office furniture, and heavy machinery. Not yachts, not your house, not antique furniture. Pro tip: even used equipment qualifies if it's for business. Second, placed in service. This means physically operational for your business in the tax year. Not ordered, not delivered. Installed and used. We'll show you how to prove this. 3. Income limit. For 2025, the deduction cap is $1.25 million. But there's a catch. If your total equipment purchases exceed $3.1 million, your deduction starts phasing out. At $3.5 million, it's gone. Now, who can actually use this strategy? The answer might surprise you. Full-time business owners, obvious. Side business owners with W-2 jobs, overlooked opportunity. Sole proprietors, Schedule C filers. Single-member LLCs, independent contractors. Let's look at 2 real examples. Example 1. A Texas contractor bought $287,000 in excavators and trucks. They deducted every dollar that year, saving over $100,000 in taxes. Example 2. Sarah, a marketing manager earning $95,000 at her day job, started a weekend consulting business. By properly applying Section 179 to her home office setup, computer equipment, and business vehicle, she legally reduced her tax bill by $6,800, all while building business assets for her side hustle. The key point: you don't need to be a full-time entrepreneur to use this strategy. You just need a legitimate business with profit motive. Section 2. The 6,001-pound vehicle hack. This is where Section 179 gets really powerful. Vehicles over 6,000 pounds gross weight qualify for full write-offs. Not just partial, not over time, the entire purchase price. Let me show how. Let's compare. Buy a $50,000 personal sedan? $0 deduction. Buy an $80,000 Ford F-250? You could write off all $80,000. As long as it's used primarily for business and falls within the annual limits. Step-by-step proof. Step 1. Look up the gross vehicle weight rating on the manufacturer's website. If it's over 6,000 pounds, it qualifies. Step 2. Brand it. Add a logo or vinyl wrap. The IRS loves visible proof of business use. Step 3. Track your mileage. Use apps like QuickBooks or MileIQ to log trips. More than 50% business use is mandatory. Here's a list of popular vehicles that qualify in 2025. Cadillac Escalade, Chevrolet Tahoe, Suburban, Ford Expedition, F-150, F-250, GMC Yukon, Jeep Grand Cherokee, Wagoneer, Lexus GX LX, Mercedes GLE, GLS, Tesla Model X. Red flags that trigger audits. Claiming 100% deduction for a vehicle with no business branding. No mileage logs or client visit records. Personal errands on weekends. Never document these. Vehicles that don't match business purpose. Sports cars for plumbers. Example calculation. Business owner purchases $65,000 SUV with 75% business use. Section 1. 79 Deduction. $28,900. Maximum for SUVs. Business use percentage. 75%. Allowable deduction. $21,675. Tax savings at 32% bracket. $6,936 in first year alone. Section 3. The Audit-Proof paper trail. Here's exactly what to keep. 1. Purchase records. Dealer invoice, showing date, price, bank statement proving payment, sales contract with VIN number, delivery and installation documentation. 2. Usage proof. Google Maps timeline showing trips to job sites. Client invoices with vehicle use, noted, time-stamped photos of equipment at work, business purpose documentation for each asset. 3. Form 4562, highlighted line 12. This is where you claim the deduction. Note, never round numbers. $83,217 looks real. $80,000 looks fabricated. The burden of proof is on you, the taxpayer. Here are 3 audit-proof documentation systems used by strategic business owners. 1. Digital receipt management with business purpose noted. 2. Automated mileage tracking with client destination logs. 3. Asset usage tracking for items used for both business and personal. These apps make compliance simple. QuickBooks, MileIQ, Expensify, and FreshBooks all have features specifically designed for Section 179 compliance. Section 4. Powerful combinations and advanced tactics. The most strategic tax planners don't use Section 179 in isolation. They combine it with other tax provisions to create even more powerful results. 1. Bonus depreciation. Stack Section 179 with bonus depreciation. Another IRS rule that lets you deduct another 20% immediately. Example for large equipment purchase. $150,000 equipment purchase. $100,000 applied to Section 179. $50,000 remaining eligible for bonus depreciation. $40,000 bonus depreciation. 80%. Combined first-year deduction. $140,000. Tax savings at 32% bracket. $44,800. 2. Home office expansion. Did you know your home office qualifies if you store equipment there? IRS allows $5 per square foot under the simplified method. 3rd software surprise. Cloud-based tools like QuickBooks or Adobe Creative Cloud. 100% deductible under Section 179. 4th retirement combination. Combine Section 179 with retirement contributions for dual tax benefits. Example calculation. $30,000 in Section 179 deductions. $25,000 in retirement contributions. Combined tax savings at 32% bracket. $17,600. Example. $250,000 in equipment plus $50,000 software equals $105,000 tax savings. 35% bracket. Strategic timing. Purchases must be made and placed in service by December 31st to count for this tax year. Plan major purchases during high-income quarters to maximize benefits. Action plan and closing. Here's your step-by-step action plan to implement Section 179 strategies. Immediate action. Verify business entity status and structure. Set up proper accounting and tracking systems. Conduct business needs assessment for purchases. Contact tax professional with Section 179 expertise. Begin documenting business use of existing assets. Before December 31st, complete qualifying purchases. Ensure assets are placed in service. Document all business purpose and use. Maintain detailed records of transactions. Confirm delivery and installation documentation. Tax season preparation. Compile all Section 179 documentation. Prepare Form 4562 information. Calculate business use percentages. Review for compliance and optimization. Implement audit protection measures. This isn't theory. These are real deductions used by smart businesses for decades. Final warning. Remember, Section 179 isn't a tax loophole. It's an intentional provision designed to incentivize business investment. Using it properly isn't tax avoidance. It's smart tax planning as intended by the tax code. Tax laws change yearly. Smash subscribe and bell icon if you liked the content and want to see such valuable content.